Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of DuPont Analysis Explained, a clear guide to measuring financial performance. Ever wondered how to truly understand a company's financial health? DuPont Analysis breaks it down. This method simplifies complex financial data, helping investors and businesses pinpoint what drives performance. By examining profitability, efficiency, and leverage, it uncovers key insights that traditional metrics might miss. Whether you're evaluating investments or strengthening your business strategy, understanding this framework is a must. Understanding DuPont Analysis. The DuPont Analysis is a powerful tool for breaking down a company's financial performance into easily understood components. By examining the factors behind return on equity, ROE, it provides clarity into what drives profitability and where improvements are possible. This method helps businesses and investors make smarter decisions based on a more detailed financial picture. Definition of DuPont Analysis. DuPont Analysis is a financial assessment framework that evaluates a company's profitability, efficiency, and financial leverage. Its primary purpose is to determine the key drivers behind a company's ROE, which is a measure of how effectively shareholders' equity is being utilized to generate profit. The formula expands ROE into 3 key components: net profit margin, how much profit is earned from total revenue; asset turnover, how efficiently assets are used to generate sales; equity multiplier, how much the company relies on debt financing. By breaking ROE into these parts, DuPont Analysis highlights the individual influences on a company's financial performance. For instance, a company with low ROE could be suffering from poor profit margins, inefficient use of assets, or an over-reliance on equity over debt. This structured approach makes it easier to pinpoint areas for improvement. Historical context. DuPont Analysis originated in the early 20th century, developed by the DuPont Corporation. Initially, it was used as an internal management tool to assess the performance of different divisions in the company. The method's focus on identifying and optimizing efficiency made it a natural fit for the manufacturing giant. The concept was introduced to the public in the 1920s when DuPont invested in General Motors and sought a systematic way to evaluate its return on investment. This approach soon gained traction beyond DuPont, becoming a widely used financial analysis tool in industries worldwide. Its structured breakdown of ROE offered a revolutionary way of assessing performance at a time when financial analysis was still in its infancy. Over the decades, it has evolved into a cornerstone of financial strategy, admired for its simplicity and effectiveness in pinpointing causes of strong or weak performance. At its core, DuPont Analysis remains relevant today because it brings transparency to financial data. It transforms ROE into more than a single number by revealing the interconnected elements that influence profitability. This clarity has cemented its place as a cornerstone in both academic finance and real-world business strategy. Components of DuPont Analysis. The components of DuPont Analysis are what make this framework so effective in understanding business performance. By breaking down return on equity, ROE, into specific parts, it becomes easier to see where a company excels and where it struggles. Let's explore each component and how it shapes overall financial performance. Return on equity, ROE. Explain the significance of ROE in assessing company performance. At the heart of DuPont Analysis is ROE, which measures how well a company turns shareholders' investments into profit. A high ROE is a signal of efficient management and strong financial health. It shows whether the company is making smart decisions with its equity. Think of ROE as the ultimate report card. Investors use it to assess whether their money is being well utilized. For businesses, it's a benchmark for setting goals and tracking progress. Is the company profitable? Is it managing its resources wisely? ROE answers these questions in a single number. However, ROE doesn't give the full picture on its own. That's why breaking it down into smaller components is so valuable. It uncovers the why behind the number. Profit margin. Discuss how profit margin affects ROE and overall business efficiency. Profit margin is like the engine that powers ROE. It represents how much of a company's revenue turns into profit after expenses. The higher the profit margin, the better the company is at controlling costs and maximizing earnings. For example, if a business earns 25 cents profit for every dollar of revenue, it has a 25% margin. That's a solid indicator of efficiency and operational control. A low margin, however, might suggest challenges such as rising costs or pricing issues. Since profit margin is one component of ROE, even small changes here can have a meaningful impact. Businesses with strong margins generally post higher ROE, assuming other components remain stable. Simple takeaway? Improving profitability, whether by cutting unnecessary costs or optimizing pricing, can directly enhance ROE. Asset turnover ratio. Describe how asset turnover reflects operational efficiency. The asset turnover ratio measures how effectively a company uses its assets to generate revenue. It answers one key question: how hard are your assets working for you? If a company has a high asset turnover, it means they're squeezing the maximum value out of their resources. For instance, a retailer with high sales but modest assets, like inventory or store space, likely has impressive operational efficiency. Low asset turnover, on the other hand, might point to underutilized resources or ineffective processes. For example, expensive equipment sitting idle drags down this metric. Since this ratio directly feeds into ROE, it's crucial for businesses to focus on optimizing asset use. It's not just about having assets, it's about using them wisely to drive sales and profits. Financial leverage. Explain the role of financial leverage in enhancing or detracting from ROE. Financial leverage, often reflected by the equity multiplier, shows how much debt a business uses compared to equity. It's essentially a measure of risk. While leverage can amplify ROE, it can also backfire if not used carefully. Imagine driving a car fast on a curvy road. Sure, you'll get there quicker, but one wrong turn can lead to disaster. That's what financial leverage is like. It enhances returns when things go well, but it increases losses if the business hits a rough patch. Higher financial leverage means a company is taking more risks by relying on debt to fund growth. If managed properly, this can lead to higher returns for shareholders. Yet excessive leverage can strain finances and hurt ROE during economic downturns. The goal? Striking the right balance. Companies should aim to use leverage strategically, ensuring they can handle repayment even if profits dip. Calculating DuPont Analysis. Understanding how to calculate DuPont Analysis is essential for evaluating a company's financial performance. It breaks return on equity, ROE, into three easy-to-understand parts: profit margin, asset turnover, and financial leverage. These steps will guide you through the process. Step 1. Calculate ROE. To begin, calculate the company's return on equity, ROE, using the basic formula: ROE equals net income, shareholders' equity. This shows how efficiently a company is using its equity to generate profit. For example, if a company earns $100,000 in net income and has $500,000 in shareholders' equity, its ROE is 20%, $100,000 divided by $500,000. ROE alone provides a high-level view of performance, but to understand what's driving it, we need more detail. That's where breaking it down into components like profit margin, asset turnover, and financial leverage comes in. Step 2. Analyze financial statements. You'll need financial data from the company's financial statements to proceed. Here's how to gather the data you need. Income statement. Look for total revenue and net income. Balance sheet. Identify total assets, total liabilities, and shareholders' equity. Notes to financial statements. Review these for additional context, especially on debt or unusual expenses. Make sure the data you use is from the same reporting period. For example, use annual figures consistently instead of mixing quarterly and yearly data. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.